Hi, hi everyone. A very good evening to all the participants who have just joined us here at this REHDA webinar entitled The COVID-19 and its Impact, Managing Tax Concerns for Property Developers, jointly brought to you by REHDA Malaysia and REHDA Selangor. My name is Edward, and I will be your host for today. Before we go into the discussion, let me just do a quick introduction of our esteemed panel of presenters today. The first panelist will be Dato Soo Chan Fai. He's actually currently the Group Financial Controller of Ecoworld Development Berhad, and he's also the Chairman of REHDA's Taskforce for Accounting Standards and Taxation. He's a MIA member, and he's actually a member of the MFRS Application and Implementation Committee. Dato Soo, maybe you can just wave to the participants so that they know who you are. Okay, the next speaker is actually Mr. Steve Chia, a very good friend of mine who I've known for a long time, very senior partner of PwC Taxation. Okay, he's a fellow of ACCA, fellow member of ACCA, and a member of the Chartered Taxation Institute of Malaysia. He has actually been involved in the tax line, advisory line for more than 20 years now, and has undertaken various compliance and advisory work for both locals and international clients. He was actually a member of the Public Finance Reform Lab under Strategic Reform Initiatives Pemandu at one point in time. So, of course, the last speaker, Mr. Sarah, the important man, he's finally here. Okay, he's supposed to be busy, yet he took his time off to join us on this panel. Okay, Mr. Saravana Kumar, he's actually the founding member of the firm Rosli Dahlan Saravana Partnership, and is an advocate and solicitor of the High Court of Malaya, a barrister at law in Inner Temple. Okay, he holds an LLB from University of London, a master's in taxation from London School of Economics, and a master's in development planning, University College London. Hey friend, your one very long.
I know, you don't read all that, it's too long.
Okay, anyway, most importantly, he's recognized as one of the top lawyers in the country. Okay, recently he was a top 100 lawyers in Malaysia 2020 under the Asian Business Law Journal. Okay, so I think what is important is that this panel is extremely a very high-powered panel that we have actually gathered together to look at some of the tax issues or what are the things that we can do in view of the difficult situation created by this COVID-19 and the MCO. Okay, so I don't think I want to take up too much of the time. I think the first presenter today will be Dato Soo. He will share with you some of the so-called pains of a developer. So, and then of course, Steve will come in with some of his what are the tax incentive as well as what are the implications that you potentially will have, while Sarah will then look at it from the legal aspect to see how we can actually put our position better. Okay, Dato Soo, I will pass it to you now.
Okay, hello everyone. Good day to you, and thank you to Edward for the kind introductions. I think in today's, no one is in high power. The high power one is actually the unseen virus, probably. So we are all vulnerable in this very unprecedented, very unseen circumstances now, actually. Okay, my session today will be won't be take too long. I think main thing for today will be Steve and Sarah. I think both of them will probably share a lot of thoughts with us, and in terms of how to get ourselves prepared when it comes to all the tax concerns. Obviously, during this unprecedented COVID-19 crisis period, the biggest issue for the developers is always because there's a stop work order, and of course subsequently or even during this MCO period and extended MCO period, we can see certainly the sales will be under a lot of pressure to come in, and of course all this one eventually related to the cash flow of the developers. I think cash flow of developers, known to many, is essential to actually meet a lot of payments, a lot of obligations, including banks, their contractors, consultants, So we got this whole chain of economy beneficiaries there we are taking care of as well. Therefore, the developer needs to be extra careful during this period and come to all these items. Again, I think I would like to actually, as far as REHDA is concerned, want to say appreciation to the government, particularly for the very quick response. They have actually came up with various incentive and stimulus, and those incentive stimulus, those are some of them are very critical. But particularly, if I could probably show the sum in the slides later, and those will ease the cash flow of many developers, many businesses as well, and particularly for those in the SME group. Shalik, are you showing the slides already? So I would like to start off these things with those incentive and stimulus shared by the by the government, and of course the one most straightforward is the deferment of the employers' EPF contribution from April 20 to June 20. The loan moratorium, for me personally, this is perhaps one of the most critical announcement by the government or by the Bank Negara. Is almost enjoyed by SME on the automatic form. As long as their account is not in arrears for more than the 90 days, as at the 1st of April. There's an interest and principal repay deferments, and actually even for some of the non-SME, like those corporate in those listed developers, many banks actually consider the loan moratorium application by the borrower under using the same spirit of the Bank Negara Malaysia. This is very much want to ease the business community in terms of the cash flow pressure during this period. Of course, government also announced various financial measures to support SME. I think those I can perhaps want to share will be those special relief facility. There's a 5 billion been announced. I understand from bankers this is there are already many applicants to this particular special relief facilities, and of course there are some conditions to be fulfilled. And the other facilities which is offered to all the SME and business community will be the guarantee facility. There's another 5 billion sum there. But I've been told this particular facility is still at this moment not firm up in terms of the structure or the mechanism yet. I think all business community, we are still waiting for the further guidance from the perhaps Bank Negara or the banks or even Dana Jamin, how to actually take advantage of this particular facility. Construction sector has been allowed to actually operate during the extended MCO. The MITI, although initially there's some glitches, I think along the way they sorted out all the application part. In fact, even before this 4th of May, sort of like partial opening, some of the developers already got a construction site running on the grounds. Although this one, there are still many kind of SOP, other details to be fulfilled before construction can start. But nevertheless, that actually gives some room for the developer to start to actually hit the ground, because the moment this one can be done, actually developer can actually generate some cash flow in the coming months from those already locked in sales. That is very crucial actually for developers. Tax installment revision at the 3rd month, on top of the usual 6 and 9 months, this will actually give the developer another way to plan their cash flow so that their tax payment will be commensurate with their business activities of the year. Last is a reduction in the foreign workers levy. On this part, I'm not sure how it will benefit directly to the developer, but of course, eventually, if there's some saving, I'm sure the contractor, perhaps one way or another, this will be passed on to the developers. Okay, next slide, please, Shirley. So I think now the crucial part of this entire thing is we are stepping into the new norm. This new norm about people's behavior, community behavior, and also this new norm about people are being more cautious, people are being careful of the job, you know. So with this new norm, developer cannot run the business as usual. I think everyone need to adapt to the environment. Of course, I will not deny during this window period, some might want to see that there's this good opportunity to pick up some good investment as well. Particularly those investment can generate good yield. Those investment can have long-term capital appreciations. Now is a very much a buyer's market. I think many developers actually have very, very good deals. And also, we have to take into consideration also Bank Negara has also just yesterday, in fact, reduced the OPR by another 50 basis point. You know? This low interest regime kind of like situations will actually encourage probably some investment into the property as well. Of course, for the developers, in order to meet the cash flow requirement, in order to actually generate cash flows, they might go into various kind of like arrangement and new business model in order to do so. I think one of the things might be done by the developer would be this sale and leaseback deal. This could be a kind of like very could be a kind of like a popular deal when it comes to the particularly investment assets, those commercial assets. There are certain developers certain purchasers looking for some fixed yield. So within sale and leaseback, perhaps it will spur up some interest on the commercial property. Rent with option to purchase is many developers actually run into this scheme. One thing is to generate some short-term cash flows. Second thing is perhaps to enhance the chance of selling the same property back to the lessee in the future. If they like the property, if they do some business there, even the family live happily there, you know, this rent will be the option to purchase. And developer might along the way, because of the cash flows issues, because of the forward planning, they might actually restructure some of the unsold stock for refinancing purpose. You know, this one can come in various forms. Depends on how the bankers actually advise the developer to do it. But certainly, this is probably one of the area would be looked into by the developers. For those developers have a joint venture, have those not 100% owned subsidiaries. Along the way, some injection of fresh capital could happen. So when this happens, perhaps there's some attention to pay to when, especially when there's a change of in terms of the capital ratios of those of the joint ventures. Tax estimation, although the government has given us, IRB has given us a third installment start to do the revisions, and as 6 installment, as 9 installment can do. But we also have to take into consideration during this period, a tax estimation can be very tough because of a very uncertain kind of like business environment. And of course, developer have to be very mindful. If there's any 30% variance in between, there's still a penalty on those underestimated tax. Intercore charges perhaps is another area developers has to sort of pay some attention to, particular on those interest on advances. So in order to maximize the tax benefit that available. Of course, for some of the investment properties, some of the developer with investment property, this is another concern area, particularly those have applied this fair value model, you know. So if valuations of the properties is under pressure, that could actually give some impact to the P&L directly. Yeah, that's all what I want to mention about all these developer concerns. Of course, another concerns which is very real, and to developers will be those in the aspect of the handover. For those developers got a handing over in the month of May, June, and July, and even in August, it might be actually subject to some delay because of the MCO. I think respectively, REHDA has advised all the developers to apply to the KPTK on the individually to get the necessary extensions. So this could be one of the concerns of the developers. If the KPKT approval is not come forth, then it might be some issue of LAD and how to pick up in the council. That's all, Edward. My part, I would actually pass on this one to Steve. Steve perhaps will share with us more in details on some of the tax planning and some of the concern areas to be picked up on all those developer concerns. Yeah, back to you, Edward.
Okay, thank you very much, Dato Soo. I'd like to invite Steve to continue to present his slides. But I think just before that, maybe just a housekeeping thing. We will have a Q&A session later. So if any of you who are joining through Zoom, you can actually there's a Q&A tab at the bottom of the screen. So if you want to ask any questions, please put your questions into the Q&A screen, and preferably not on the chat side, because I think Q&A will be easier for us to monitor. Thank you very much. I'll pass on the session to Steve now. Thank you.
Okay, thank you very much, Edward. Thank you, Dato Soo, for the good explanation. Good afternoon, everyone. And it is a pleasure for me to be able to speak to all of you today. And I believe some of you are already back to the office, while others are still working from home. Like myself, I'm still at home. But irrespective of where you are, I hope you and your loved ones remain to be safe and healthy at this moment. As what Dato Soo shared, the current COVID-19 situation is posing a lot of challenges to the property sector. And it is important that businesses take proactive steps to manage them. With any of these decisions, there's always tax consequences that we need to address. Shirley, perhaps you can move on to the next slide. So what I plan to do in the next 10 to 12 minutes or so will be to take you through some of these areas and what you should consider in managing the company's tax position. Okay. Due to time constraint, because I'm only given about 10 to 12 minutes, I'll not be able to discuss each point in detail, but I'll try to provide some broad overview in terms of the things that you all can consider. But of course, if there's any points that you want me to expand further, do raise them during the Q&A session, then I'll be happy to elaborate further on that. Okay, so based on that, how I will plan to run through my session is to cover the broad tax concerns and issues based on these categories. Okay, one will be looking at what will be the tax impact arising from the declining sales and the delay in project delivery due to the MCO. Post-MCO, your portfolio of your assets and land holdings in terms of how you're going to use that may change. Your funding requirements, I think cash is king now, so we need to look at how you actually fund your requirements. And I suppose as we exit from this COVID-19, there'll be a lot of new norms that could have been established. So how would that sort of involvement of new business models will actually impact tax? And last but not least, I think Dato Soo has covered quite a fair bit, is how can you benefit from some of the various stimulus measures that was announced by the government. Okay, so with that, if I move on to the next slide, let's start off by looking at businesses that is faced with declining sales and delay in project execution. So first, if your business is expected to have lower profits and you have not already done so, you should look at your tax estimates, as what Dato Soo mentioned, and revise it downwards to reflect the current profitability situation of your business. Under the stimulus package, you'll be able to do so in the third monthly installments, in addition to the 6th and the 9th month revision. Okay. Another point perhaps to look at is actually your interco charges, because to see whether is there any avenue that you can make revisions to these charges to be more reflective of the current operating environment that you are in. Of course, you need to have robust transfer pricing documentation to support those revisions as well. In an unfortunate situation, if your business is then making losses, then I suppose the question is, how do you deal with those tax losses? In the past, we have the avenue for group relief, but it should be noted that the group relief provisions has recently been tightened, whereby only newly commenced business can surrender their tax loss for up to 3 years of assessment. So if you're an existing company in operation for some time, the group relief provision is actually not for you. On top of that, the utilization of the tax losses is now restricted to 7 years. So taking into account all of that, you may want to actually start looking at your business plan moving forward to see how you can accelerate the utilization of these losses, because otherwise, after 7 years, you'll be lost. For example, looking at injecting profitable activities into the companies to utilize these losses. Of course, with any restructuring, there must be a commercial rationale in place to support in the event queried by the tax authorities. Due to the challenging market conditions, I suppose property developers, as mentioned by Dato Soo, will have to deal with unsold stocks. Okay, so in order to generate some cash pending sale, you may be renting out some of these properties on a temporary basis. But on that front, you need to be careful, because potentially by doing so, the company could be seen to have withdrawn the stocks to earn rental income. And as you're aware, stocks withdrawal from a business is subject to income tax based on the market value of the property. So if the intention of the company is continue to look out for buyers to sell the properties, then you should need to have robust documentation to reflect this intention so that the tax character remains unchanged as trading stocks. Because otherwise, RRB, when they come in for an audit, they may challenge that stock withdrawal has happened. I think the other area to increase the marketability on your unsold stocks could be the Bumi quota release that you could be looking at applying to the authorities to get a waiver, whereby that will mean that you may need to pay some contribution to the state authorities. But as you're aware, these type of payments have been challenged by the tax authorities in terms of its deductibility. So perhaps I will leave that to Sarah to actually comment this further, because there are a couple of case law that's been decided on this. And in addition, I also understand that REHDA has also been pursuing this matter with the authorities as well. So hopefully we'll get some good news for the developers in the coming months. The next area that we move on is actually looking at contractual obligations in relation to delays resulting, say, in your resulting in LADs, and that could come from both sides, where you could be getting LADs from your contractors. At the same time, you may have to pay out LADs to your purchasers. So if you are getting LAD from your contractors and at the same time having to pay your purchasers, it is important to ensure that the timing of the taxability of the LAD income, as well as the deductibility of the LAD payments to your purchasers, are properly matched. Otherwise, this could result in a timing leakage to the company. Because under the RRB public ruling, in order for LAD payments to be deductible, it must be ascertained and agreed between the two parties. So by just having the contractual obligation to pay the LAD payments does not warrant you an immediate tax deduction based on the RRB's public ruling. The last area that I'm looking at is on, of course, with all these issues, you could be looking at right-sizing your operations. So because of the depressed market conditions. So with any restructuring, there's always tax costs involved, such as RPGT, stamp duty, when you try to actually move things around. So an area that you need to look at is explore opportunities for any potential tax exemption or reliefs that's available and provided for by the government. There could also be retrenchment of VSS, not a popular topic, but I think potentially it could be inevitable. So generally, payments for right-sizing of business operation, getting based on case law, should be tax deductible. But however, if such payment is made arising from a cessation of a business or a significant portion of the business operation has been ceased, then this could potentially connote a capital payment. So something that you need to look at and consider whether if you do have such payments, would that be deductible to you or not? Okay. So that's basically what I plan to cover for this slide. So if we move on to the next slide, in terms of looking at your asset and your land holding portfolios. So what I covered thus far is more from the P&L perspective. So now let's look at it from your assets, your balance sheet. So in this period of time, I think the first point that you all could be sort of grappling with is whether do you need to do impairment on your assets. So unfortunately, allowance for impairment is not tax deductible. Okay, so one opportunity which I think can be sort of coupled with the points that Dato Soo mentioned about using your unsold stocks to go for refinancing, you may try to actually put all these unsold stocks, say, into a dedicated company by transferring the ownership. And by doing so, you will also indirectly crystallize the losses arising from these impaired assets. Okay, and that would then be able to be used to offset against your taxable profits. But of course, with any restructuring exercise, the commercial rationale must be there to basically support what is the basis why such arrangement is being undertaken. Okay. The next point is in relation to characterization. Okay, as you review your development plan and your project requirements post MCO COVID-19, there could be changes to your plans, your development plans, and your intention as regards to your properties and your land banks, which may result in reclassification. So as you know, for tax purposes, when asset is being reclassified from stocks to investment property, IP, or PPE, there may be income tax exposure stock withdrawal provision and GT to consider the tax characterization of these assets, okay, and do the reclassification, because that would then minimize your tax exposure. So similarly, if you have contemplating to move some properties around between group companies, this again would be a good timing in view of the potential lower valuation of the properties. Okay, so those are some of the points that you can actually consider when it comes to your assets. So Shirley, if I move on to the next slide, so if we then say look at the funding requirements, so in difficult times, of course, cash is king, and you could be looking at funding to boost your cash flow position, and this may include even cash calls from. So particularly say the development project is a joint venture, right? So if the shareholders are injecting equity into the business, being a land-rich company, chances are the shares that will be issued will likely to be tainted to be a real property, or what we call an RPC shares. So this will potentially impact at your exit, because when you dispose of these shares, then that will be subject to RPGT. And if you issue the shares now and you're disposing that, say, in the next 3 to 4 years' time, then your RPGT rate applicable will be a lot higher due to the shorter holding period. So if you have these types of instances, then instead of using ordinary shares, other funding options such as redeemable preference shares or even a shareholder loan should be considered instead. Okay, so that's in relation to the cash calls. On the loan moratorium, so Bank Negara, as what Dato Soo mentioned as well, has announced loan moratorium measures, and businesses can actually reach out to their banks to restructure the loan arrangement. So care should be given as deferment of interest payments would mean that you are deferring the due date of the interest. As interest deductibility today is based on when the amount is due to be paid, this would postpone the deductibility of the interest deduction. So just be careful. When you restructure your loan, you don't want that your interest deductibility get deferred to a later date as well. If you look at internally, in terms of intercompany lending or loans, if the borrowing entity is not able to service the loan, say because the company is in a loss position, then the restructuring of such loan with the group lending entity to defer the interest due date may be beneficial in this case. As the borrowing entity is in a loss position, so the interest deductibility is not critical, but by deferring the due date of the interest, the lending entity can then not be taxed on the interest until the amount is due to be paid, because that's how the law is provided when it comes to intercompany lending. So this will be something that you may want to look at when it comes to group situation, so that the overall tax position of the group can be maximized. The last point on this slide is in relation to debt restructuring. So normally when you talk about debts, in this difficult point in time, there could be potentially waiver of debts involved. So you should ensure that the character of the debts are supported and the basis is documented so that the appropriate treatment can be accorded. Okay. Otherwise, RRB may disallow the bad debts deduction to the debtor or tax the creditor on the amount waived. Okay, so that's in relation to the points on funding requirements. So if you move on to the next slide, that will be how would then you respond to the new norm? Okay, so as businesses are exploring alternative business models to try to push your products, to push your sales, I think Dato Soo mentioned a couple of them, like rent to own or rental with option to purchase, sale and lease back. Those would definitely have tax consequences that need to be looked at. If you were to offer rental, would this immediately trigger stock withdrawal, as what I mentioned earlier? How would the rental income be taxed under an RTO scenario? Because ultimately the rental income that you get is going to form part of the total consideration of the sale of the units. So those are the questions that you need to look at and address when considering all these different business models. Okay. The next point is that in the new norm, we are using Zoom now to actually do this type of webinar. There will be likely that companies will be investing more in technology to basically explore new ways to reach out to your customers, to your target audience through virtual marketing and all that. So some of this technology will come from overseas, and you definitely need to factor in your withholding tax costs, your service tax, even though it's from foreign service provider, that could be subject to imported taxable service provisions, and you may need to self-account the service tax. And of course, the recent introduced digital service tax will be another layer of cost to you as well. So that's basically some of the key points I thought you may want to think about when it comes to responding to the new norm. I'm coming to my last slide, which is basically just, so Shirley, if you don't mind, you move on to the next slide. Okay, so basically these slides, I do not plan to actually go through that because a couple of points have already been mentioned by Dato Soo just now. So these are some of the key measures which I think would be relevant to property developers. So I do not plan to go through that in detail, but of course, if you do have any questions on some of these measures as we announced, we'll be definitely happy to actually take them on during the Q&A sessions. Okay, so with that, I will end my presentation here, and I will pass the time back to Edward. Thank you very much for your attention.
Okay, thank you, Steve. I think now we will get on. We will pass on the mic to Sarah, who will share with us on the legal side of things.
Thank you. Thank you, Steve and Edward. So I will highlight on some of the key legal issues. Being a lawyer, I thought I'll put in the sections. Can we go to the first one? The one thing that's not in my slide, but that I came to my mind as Steve was talking, is contribution to the COVID fund. Developers, if you are donating funds to COVID, remember there are a couple of funds out there for COVID. There is one fund by the Ministry of Health, and there's one fund under the PM's department under the National Disaster Agency, NATMA. From my understanding, if you make donations to these two funds, these are the official authorized funds, and if you make donations to these two funds, you'll get full tax deduction. But if you make a donation to any other organization, say St. John's or Bulan Sabit Merah, where they also have their own COVID fund, and if they are charitable bodies that are approved by the IRB under Section 44(6), you also enjoy deduction, but limited. Your contribution will be limited up to 10% of your aggregate income. Now, if you go and donate to a scam, forget about it. There's no deduction for you. Okay, the IRB has issued a guideline, a media statement, reminding taxpayers to do due diligence before you go and donate. So please do your duty, because this is a time where everyone is charitable. You go and donate, but scammers scam you. You can't get tax deduction for getting scammed. Yeah. So that's one element I just wanted to highlight. And of course, they said you must retain documents to show your donation. Either you get a letter, if you give equipment, please get a letter quantifying the value of your donation from the relevant government agency. Now, withdrawal of stock is not something new. Property developers are very commonly hit in this aspect. And as Steve pointed out, there is in fact a case called Yunlian, where the taxpayer in that case built a row of shop lots They were in the business of property development. They wanted to sell the shop lots, but they eventually ended up renting out this particular property. And they made good rental, and they thought it was a good business to be in. So what they did was they brought rental income to tax. The Inland Revenue Board decided to tax the entire shop lot rows as if deemed sale and brought them to income tax. And that is possible under Section 24, subsection 2. Because evidence in the Union case was apparent that the taxpayer was not interested to sell the properties anymore, but to rent it. But in property developer scenario today, things could be different. Because if you have now difficulty in selling property or renting out property, and in fact, it is easier to sell tenanted properties, you know. It's easy to sell tenanted properties. So assuming you have a large property and you invite Tesco giant to come and rent it at a very attractive price, or even if you get, you get Starbucks or, the kind of big names as your tenant, it's easier to sell your property. So does that conduct make it subject to you withdrawing stock? My view is no. As Steve pointed out, if your intention remains to sell, the property is available in the market, but this is your way of selling the property. You want to sell tenanted properties. That cannot amount to withdrawal of stock. And that is very clear from the Mercedes-Benz case, where it is a reported case. When Mercedes couldn't sell a particular model or slow, the pickup is slow. So what they do, they gave the cars to they registered the cars under the name of Mercedes-Benz Malaysia, gave the cars to the senior management and asked them to drive, right? For the cars to hit a particular mileage. And once the cars hit the mileage, then they are sold as pre-owned cars. Okay? And IRB said these are all withdrawn, stocks withdrawn for sale. We went to court, we argued, and court accepted our argument that those cars remained as the taxpayer's stock and not what we call fixed asset, or it became their own asset. It was a way of selling cars. So remember, stock can change the way you want to sell it, but the character must remain that it is still stock. So therefore, it's very important that if you decide to rent out your property with a view of selling tenanted properties, make sure your audited accounts also maintain them as inventory still. Yeah, that's one. Second, bad debt, when someone doesn't pay you. Fortunately for developers, most units are sold, and when they're sold, they also have the units as collateral. So it's not a major issue. But if you got any side business, other than being a developer, you are in business of renting out properties, and your tenant has not paid you, and the moment the month is due, rental is due, income accrues as taxable income for you, especially if it is a business income. Yeah, and in such a scenario, you may want to treat the income as bad debt, and under the Income Tax Act, there are a number of conditions to be satisfied, whereby you must essentially show that particular debt is partly or wholly irrecoverable. You must take steps to recover first, and you must be able to establish that then, despite all the steps, the amount was not being able to be recovered. You can't take this decision, sit in your office and say, economy is bad, COVID has affected everybody, they can't pay me, so I'm not going to collect, let it be. So in your book, you put irrecoverable because of COVID. Cannot. You cannot jump into that assumption or conclusion. You must take steps. Okay? What steps to take? First, you issue letter, demand first. They don't give you, ask a lawyer to issue a letter of demand. Still, they ignore the lawyer, sue the guy, get a summary judgment, and then get enforcement. But all this depends on the amount of the debt. If it is 50 ringgit, 500 ringgit, I might as well go and pay tax rightly. I mean, you might as well let it be and pay the tax and move on, because lawyers may cost you more money. Debt collection can cost you more than the 500 ringgit. But if it is 50,000, 500,000, and your volume is very high, then you may want to go and consider doing the needful action in order to recover the debts that you cannot recover. When you can't, it becomes bad debt. Then the other part from debt is forgiveness of debt. When you forgive debt, there is a reported case involving a developer, Bandar Nusa Jaya Development, case that I did a number of years ago, where the holding company forgave the interest that was not paid by the subsidiary. that this was as a result of the 98-99 economic crisis. Yeah. So the holding company pumped in about nearly R1 billion in loan to the subsidiary, Bandar Nusa Jaya Development, for them to go and develop Nusa Jaya in Johor. Okay. And of course, you need to pay the loan. Loan was not paid, and the interest was not paid as well. But Nusa Jaya deducted the interest in their books as an expense, accrued. They will deduct every month. So they were enjoying a tax deduction. Okay. Then after a few years, the premium was revised downwards because Nusa Jaya couldn't pay. Eventually, UAM asked Nusa Jaya, "Are you going to pay or not?" Nusa Jaya said, "No, I'm not going to pay you. I cannot pay you." So Nusa Jaya then said, UAM then said, "You know what? I myself forgive all this debt and restructure it, because otherwise I am accruing interest income." Okay. So what they did, they forgave all the interest owed by the by the subsidiary. So Nusa Jaya Development had a large sum of money being forgiven. So what they did was that interest, a portion was deducted as against business income, a portion was deducted against their own interest expense, and the interest portion deducted against the interest income. So Nusa Jaya deducted the interest due to holding company against Nusa Jaya's own interest income. You follow me? Okay. Now, they once forgiven, they didn't add back the money. Okay, didn't add back because Nusa Jaya took the view, section 30 subsection 4, which is a section that you must add back when someone forgives your debt, is not applicable to that. You'll be wondering why. Because section 30 says it is only for business source income. So Nusa Jaya said, my income falls under interest. It's not business, non-business source. So 30 subsection 4 doesn't apply. I won't add back. And the tax amount here was 80 over million ringgit. Okay. So can you imagine the tax savings? You took deduction and not adding in back. So IRB came, IRB considered section 30 subsection 4 doesn't apply. So IRB used section 22(2)(b) to bring it to tax. We went to court. We won at the High Court and Court of Appeal. Federal Court has sent the case back to special commissioners. So release of debt has a tax consequence in Malaysia under section 30 subsection 4. So it is very important for taxpayers to consider that position before you forgive any debt. Next slide, please. And the next slide, if you see the next slide, now you come to compensation payments. Okay. Now, if you pay compensation to your employees, there's a case called Ampatin dredging in Malaysia, where if you're closing down business and paying compensation, it is not tax deductible because it is not in the production of income. You're seizing business. So those kind of payment, it won't be deductible. But if you're making the payment to be more effective, you have to retrench workers, you have to pay consultants for looking at your business. All those expenses are deductible if you're going to stay in business or if you're incurring the expenses to stay in business. And that is a decision in an old case called International Foods, also a Malaysian case. Yeah. So remember, compensation payment for employees, if you're ceasing business, no tax deduction. If you're paying to continue in business, downsizing to continue to exist in business, that is deductible. Payment for breach of contract, if you go and breach your contract and you can't honor certain things, you got to pay. Courts have said all these are deductible expenses. There's a nice Malaysian case called Roshindo, where I argued warranty payments to a supplier, to a customer, where my product don't meet the specified scope or job description. I said we argued it's deductible expense. Court agreed it's a deductible expense. Yeah. So payment for breach of contract is deductible expense. There's another interesting case called Herald, a newspaper from Australia. Newspaper wrote something defamatory. They were about to get sued. So they wrote to the guy and said, I'm so sorry. This is my money. I won't do this next time. And they said that particular payment is deductible. Court said that payment is deductible because if you are a businessman in your newspaper business, getting sued for defamation is a normal business hazard. So if you are paying payments because of delays or you are unable to commit or certain commitments you have made to your client, all those should be deductible expenses. Yeah. Then payment received. So this is a section that IRB used in the Nusa Jaya case. That was forgiveness of debt, but here there's a specific section for compensation payment. Is it taxable? Now, taxation of compensation can go both ways. It's either fully not deductible or it is what we call solely taxable or not taxable. I give you an example of a real case that I did. A developer was asked to build a project, okay, by the state government. So they built this project, a big what we call mall, a sort of a mall, to rent out to. It's like a Kraftangan complex. So this developer built it, okay, and the state government told them build for free, but I give you 30 years to look after the particular property, okay, and they also give a taxpayer a piece of land. The land is taxable as income under Section 28. The income from the management fee is also taxable. Suddenly change of state government, the new state government says, I want to terminate your contract, I don't want you anymore, okay, for whatever reason. So the guy said, I'll sue you. You know, I got a 30-year contract, you're terminating me after 7 years, I'll sue you. So the state government said, okay, let me compute your losses, I pay you compensation. You must pay the compensation. Is it taxable? We were able to argue in court and settle the case that that compensation is not taxable because they destroyed his entire business apparatus. His business income was, in that particular business, was the management fee. By the termination of the concession agreement, he is unable to earn management fee. And the revenue agreed that that kind of payment can be capital in nature and the taxpayer did not have to pay tax on that. So that is one example. A nice English example, a classic example would be the case of Edward, where the taxpayer owns and operates a jetty. That's their income. You come and use a jetty, you pay them a fee, that is their income. One day, an oil tanker collides with the jetty. They come and hit the jetty. There was negligence on the part of the oil tanker. The jetty owner sued the oil tanker for compensation. So because the jetty cannot be used for many months, the oil tanker owner had to pay them damages for that, for the loss of use of the facility. And the English court said that compensation is taxable income because that payment by the oil tanker is to cover the revenue hole, the revenue gap, therefore is taxable. On the other hand, where the taxpayer wanted to claim insurance and they got insurance payment to reconstruct the jetty, court held that particular payment is not taxable. So very interesting, same taxpayer, two types of payment, one is taxable, one is not taxable. So payment to reconstruct the asset, capital in nature, tax-free. But payment for cover your losses or your revenue hole, as the judge used the language revenue hole, it is taxable income for you. Okay, next slide, please. Financing costs. Now you'll be refinancing a business. All those interest expenses are deductible. Yeah, there's a case called Rakyat Berjaya in Sabah where the revenue said refinancing costs cannot be deducted, but court ruled these are all deductible expenses. Okay, so interest no issue. The headache starts with other expenses like guarantee fees, prepayment penalty, we have them, arranger's fee, commitment fee, facility fee, legal fee, stamp duty. Are they deductible? IRB says not deductible. But if you look at cases like FCD and Fernride, which involved developers and asset owners, court held that these are all deductible expenses. A very nice case is the Singapore case of IA involving a developer in Singapore. They had to withdraw, they wanted to withdraw money from the HDA account for the construction of their project. They are all developers, they bought land to build units to be sold, stock in trade. But they have to then give guarantee fees to HDA. Question here is the guarantee fee deductible or not? The Singapore tax department said cannot, but the Singapore Court of Appeal said it is a deductible expense because the guarantee fees did not create any asset for the taxpayer. Okay, so it's very clear. Deductibility of financing cost has its own peculiarities and ways to manage. If you really cannot pay money, you have so much of problem to pay your taxes, you can go to the minister or the DG. There is a section called section 129. On grounds of poverty, you can go to the DG. On grounds of justice and equity, you can go to Minister of Finance. So depending on the situation, you can go and try. No case law in Malaysia. There is no guidelines from the IRB. But if you want to be the first to try, no harm to try. Taxpayers ask, can get or not. Belum cuba, belum tahu lah. You know, you may not get full, but you may get some discount. Okay. And finally, relief for your employees. So if you are in an unfortunate position of having to relieve your workers, whatever you pay them will be taxable ordinarily, because compensation for loss of income is taxable. Section 13, subsection 1 also provide for that. Then the amount of relief they get is only 10,000 ringgit for each year of service. So, but just look at into paragraph 15, subsection 1 of Schedule 6. If you are relieving an employee because of inherent health reasons, they got medical conditions, you may want to take that route, because then the entire compensation is tax-free for the employee. So if you're paying a large sum of money, this could be a route that they may want to take during your discussions with the employees. Yeah, because you want to be this period to be easy, and you know, otherwise, can you imagine if you pay an employee 200,000 ringgit, his tax rate is about 20% already, you know, about roughly 15-20%. He ends up paying 30,000 ringgit, 40,000 ringgit in income tax. So he only gets about 160. He'll come back and negotiate with you. He say, listen, you better top up because I got to pay tax. Because the tax rate goes very high for him, you see. So best is, if you got inherent health reason and he's no longer suitable to work, you may want to go under 15.1 and give him that offer. And then the entire amount becomes tax-free. There's a real case, Ho Sun Guan, where during the 98 economic crisis was laid off. Right? He had a neck issue. He had to wear collar. So consequently, he couldn't do a front desk job. So they had to put him in a back room. Then in 98 or 99, HSBC decided to do a restructuring of the business, reimagining a business model. So they gave this voluntary package to all employees who wanted to leave. So Mr. Ho was one of them who signed up for it. He received some money, but he had to pay a lot of taxes, you know, on the compensation, because his relief was only 4,000 ringgit those days for each year of service. So can you imagine that? And he had to pay lots of taxes. But because he had a neck disorder, he could be asked to leave because of that. He could have also opted to leave because of medical condition. They forgot. He also forgot. But after they paid him under this MSS or VSS concept, he then gets a letter, and the employer also helps him to confirm he has a medical condition. But IRB said too late. IRB said the medical condition is an afterthought. Therefore, you cannot enjoy the full tax exemption. So if you're an employer, you want to make things easier for certain employees, this is one option to consider. You know, they can save quite a bit of taxes on that reason. So these are the things I wanted to share with fellow members, REHDA members, that things that you may want to be considering. Financing cost is very important. Treatment of compensation, and of course release of debt, especially inter-party transactions. And please get all this documented nicely so that you don't have any problem with the IRB when they visit you in years to come. On that note, thank you very much.
Thank you, Sarah. Thank you, Sarah, for your very legalistic and very interesting, throwing out all the case laws and everything, which a lot of people who are coming into this, who are listening in, are probably, or the majority are probably finance people, not so used to all the legal jargons. Okay, I will encourage all the participants, if you have questions, please take the opportunity to ask the panel of speakers. Okay, I have some questions here that's currently already posted. So we will probably, I think we are running a bit short of time, so we will quickly run through them so that we can answer as many questions as we can. Okay, I think probably if I look at a lot of the questions, probably it's most of it will be probably addressed to Steve. Sarah, please feel free to
Sure.
add in, because majority of it is asking what can you do to basically lower the tax position, or how do you improve your position? So okay, the first question is actually I think is referring to Steve, your slides on the development plan. You know, if you're going to change your development plan, of course, I think the question that's asked is that we should only take this opportunity because of the lower valuation. So I think basically you are saying that in your slides, you talk about this restructuring and the replanning. So of course, you will only do it because of certain reasons. So I think the question is asking whether they should only take opportunity of it because of the lower valuation, or is there any other circumstances that you can think of?
Yes, thanks, Edward. Thanks, Shirley, for the question. So you're right. I think what I have in mind is that because of the current situation, your property and all that, so this would be the best time to actually do so. Because a lot of times when the developers want to sort of reclassify the stocks into, say, investment properties, there's always that reluctance because you have to pay upfront tax in relation to your unrealized gains. So I suppose now with a lower valuation, that could potentially be a driver for you to do so. Yeah, so that's more from that perspective. Yeah, Edward, back to you. Or do you want me to just sort of go through the questions?
Yeah, I think, might as well we just run through the question.
Okay, so if I were to move on to the second question, which is you mentioned that we may consider RPS or loan for cash costs instead of ordinary shares. Would RPS still be regarded as shares for RPGT purpose? So what's the advantage over ordinary shares? The answer is that RPS will still be regarded as shares for RPGT purposes. So it will still be, if the company is an RPC, the RPS shares will still be seen to be an RPC shares if you were to dispose. But if you do an RPS, another way to actually sort of monetize that is actually through redemption. So normally practitioners' view in relation to redemption of RPS is that it's not a disposal for RPGT purposes, and therefore that should. So that's where if you do redemption RPS, that could potentially mitigate RPGT exposure. I hope that answered that question. So if I were to move on then down to the landlord special deduction for rental deduction to tenant. So basically this is actually an incentive that was announced by the government to basically encourage landlords to give rental reductions or rental rebates to their tenants. So the firstly is that in relation to the status of the landlord, it can be a company, it can be individual that basically owns any business premises, and you are basically renting that out to a SME tenant, okay, SME tenant. And if you have been reading in the papers in terms of what SME means, there is a lot of definitions. For income tax, you have one definition. For SME Corp, there's one definition. For wage subsidy scheme, there's one definition. So for this purpose, the definition of SME will follow the SME Corp definition, whereby we need to look at the number of employees or your turnover threshold to actually determine whether the tenant is a SME. And in order to qualify on a month-by-month basis, and it's only given for 3 months from April to June 2020, you need to give at least 30% reduction on a month-by-month basis. So if April, you give 30%, but if May, you only give 20%. So in the month of May, you don't qualify. I think further down, there's a question in terms of how does it work in terms of, do you just declare the direct deduction in your rental income? The answer is yes. Basically, you claim the special deduction against your rental income. So take example, if every month you actually charge 10,000 ringgit for your rental, so for the full year you could be charging 120,000. But for the month of April to June, because of this incentive, you give your tenant, and assuming your tenant is an SME tenant, you basically give a 50% discount. Okay, so which means that for the month of April, May, and June, instead of paying 10,000 each, they only pay 5,000. So that would then brings down your net rental from 120 to 105,000. Okay, how the special deduction works is that they're going to give you another 50,000. The rental discount that you're given as a special deduction. Answer.
Steve, we can't hear you.
I think your...
It's okay, right?
Yeah, Steve.
Yeah, can you hear me?
Yeah, now it's better.
Okay.
Okay, I think maybe just to add on from there, I think, you know, in terms of the rental reduction, I think one of the things that probably some of the people will want to know is that if you give a rental to a SME, but what sort of, yes, you are following the SME guidelines for the purposes of determining who is an SME. Okay, because I think one of the someone is asking for you to repeat what you just said, but maybe just before you start again, one of the area probably that I think people will be interested to know is that, you know, how do you, yes, you fall under the definition of the SME, but what documentation do you need to prove that is an SME, the tenant is an SME that falls within the definition?
Yeah, okay. So let me answer that question first. So in relation to the documents, based on the FAQ issued by RRB, they just say that you need to have a declaration by that the tenant is actually an SME. So they are not be very specific. So hopefully when it comes to the Gazette order, when the rules are out, they will be a bit more prescriptive in terms of what will be the documentation that's required. But if you ask me, some of the sort of initial thoughts in terms of what you can do is basically to get your SME tenant to give you that confirmation that they are basically SME. If they are businesses that are already registered with SME Corp, that registration would also can be used as an evidence that these are SME tenants. Okay, so and when it comes to number of employees and all that, then they may then need to sort of prove records to you as the landlord to actually support that. So those are some of the key documents that you may need to actually maintain. Okay, apologies on the internet connection. So perhaps let me repeat in terms of how the special deduction for landlord will work. So I give the example that if you have you charge rental of say 10,000 per month, so which means that your annual rental that you get will be 120,000. Okay, but being a good corporate citizen, you follow the government's encouragement to support your SME tenant. So you give them a 50% reduction on the rental for the month of April to June. So which means that on a monthly basis, instead of paying 10K, they will only pay you 5K. So with that reduction, on the net basis, you only receive 105,000 ringgit. Okay, so how this special deduction works then is that the government is going to give you a special deduction based on the amount of discount that you're given. So in this case, the discount given is 15K. So what you do is that you take 105 minus 15, giving you a net taxable amount of 90K. And then, of course, then you can still take deduction on your interest, on your quick rent, and whatever not to arrive at your final taxable amounts. So that will be how the scheme will work in relation to this special deduction. Hope that's clear.
Okay, I think everybody seems to be interested in this rental reduction because I think can see a lot of questions relating to that. I think the interesting question, there's one question that talks about the 30% for 3 months, but will we be entitled to special deduction only if I only give to certain tenants within the same property, which means that you're not giving it across the board lah.
You can. Effectively, it is on a tenant by tenant basis. So your calculation will be on that basis as well. So only qualifying tenants that you give more than 30%, then you will qualify. Yeah.
Maybe Steve, I think maybe we can move on to a different topic. Okay, revised tax estimate. I think that's the next question. Is this applicable for the financial year end 31st March?
The answer is yes. So as long as your third monthly installment falls in the calendar year 2020, then you will be able to enjoy this third monthly revision. So if I take a 31st March example, you basically, your original estimates have to go in by 1st March 2020, and your third month installment effectively will be in July, right? So then in the month of July, then you can actually do a revision under the third monthly installment concession given by the government under the stimulus package. Yeah. So the answer is yes, you can.
Okay, the next question is on the liquidated damages. So I think the first part is talking about in terms of tax deduction, what's the document required to prove the LAD is agreed? And I think the second part is when I think the statement is talking about when you time the LAD, how can I do that if I recognize revenue for the project in prior period? Is there a concession for carryback, or the timing refers to LAD income from supplier against LAD expense to customer?
Okay, so in relation to documents, so you all are developers, so you may know more in terms of the exact documents. Basically, I believe when you agree the position, say with your, okay, sorry, this is between developer and purchaser. So I suppose when the developer basically issues the confirmation to the purchaser in relation to the amount of LAD that is to be paid, you can use that as a document to support that will be sort of the agreed amount, and that has been signed back by the purchaser for agreement. Yeah.
Basically, I think that's something that we have, I believe.
Yeah. So I think in relation to the timing, unfortunately, for tax purposes, we don't have carryback provisions. I think for developers, the only item that they allow carryback is on the defects liability. So in relation to LAD, there is no carryback. So you just need to ensure that you need to crystallize that amount as soon as possible to generate the tax deduction.
Okay, the next question, I think Bumi quota release, we will just hold on for a while. Maybe we will come to that. Is the next question that probably, Steve, is the government subsidy to employee salary a taxable income to employer?
Okay, so we are waiting for the RRB to come up with some clarity on that, but generally, a government subsidy, there is an exemption order that has been put in place, whereby that amount should not be taxable, but it also provides that whatever expenses that is used to be covered by those subsidies would then not be deductible. So for example, if we are referring to the wage subsidy scheme, if basically you are getting these schemes in order for you to pay the employees' salaries, so then the portion of the employee salary that is covered by the wage subsidy scheme would then not be deductible. So effectively, you cannot have a win-win outcome. So in this case, you don't tax it, but at the same time, the expenses that is used to be covered by this subsidy will not be deductible.
Okay, Steve, maybe the next one is that how can we justify the deduction of financing costs such as arrangement fee, commitment fee, syndication fee, guarantee payment in our tax return? Because IRB has been disallowing such fees, or even though they are legitimately deductible.
Perhaps I'll get Mr. Sarah to respond to this.
Yeah, maybe. Sarah?
I don't know why IRB doesn't allow them in Malaysia. They take the view this is all capital in nature. But if you look at the cases like Forest City Development and Fundrai, courts have said the link, the nexus between those expenses and the income production is so clear. This is the cost that businessmen have to incur in order to raise funds to go and run their business. It doesn't create any asset for them. So it seems to be a policy decision that the IRB has taken in Malaysia that guarantee fees cannot be deducted, even if it is for revenue purpose, like how developers incur it. And Singapore used to take the same position as well. But after the Singapore High Court of Appeal in the IA case ruled that these are deductible expenses, then I guess the Singapore IRS has now changed their position. They allow this a deductible expense. So I really hope the government will, it is one of the proposals I put forward to the government in various forums that please make this kind of financing cost deductible. It's easy because you don't want to make the cost of doing business in Malaysia more complicated and more expensive. And these all are common sense expenses,
Okay. The next question probably we'll take is during an economic downturn, how best should groups strategize their interco loans and interest to maximize their tax deduction? Example, in forgiving outstanding interco interest or outstanding interco advance. So Sarah or Steve, who would you like to take this?
I can start first.
Okay.
So I think I've sort of covered that in my presentation, but I think the rule to this is that it's simplification. But in terms of simplification, interco, that applies whether it's in a crisis or in non-crisis. But I suppose if you're in a crisis mode, things are a lot tighter, then I believe that would be an area that you should be focusing on to actually try to simplify that. Because once you simplify your interco loans, it will also minimize the interest cross-charging between the group of companies. And because under TP now, generally the expectation is that you need to charge interest on your intercompany borrowings or lendings. And therefore, if you have one company that is actually loss-making, but the other entity is actually, the lending entity has to pay tax on the interest income, then on a group basis, that may not be tax efficient. So as mentioned earlier in my presentation, one way you can look at that is potentially converting that amount owing to a long-term loan between the group entities to say that I will basically defer the payment of the interest in relation to the loan so that the lending entity can also defer the taxability. Because under the tax provision, when it comes to intercompany loans, the interest income will only be taxable when the amount is due to be paid. So we are basically using that to try to defer the taxability of the interest income, but that will have an impact to the borrower where the interest will then be deferred, the deductibility will be deferred. But of course, if the borrower is not a profitable concern, then that may not be such of an issue. So those are some of the sort of points that you may want to actually look at. Of course, debt forgiveness to clean up the amount is also important. But I must warn you, debt forgiveness is an area that RRB is now focusing on. So just be careful, ensure that you have the proper documentation. As what Sarah mentioned, even though there are case laws that decided in favor of taxpayers, but unfortunately, RRB are quite sticky on this point. So if you cannot prove the characteristics of the debt that has been forgiven, they will just say that that becomes a taxable amount. So just be mindful of that. Okay, Sarah, anything to add?
Yeah, no, I echo whatever Steve said. It's a major issue now. In fact, forgiveness of debt, I have had a case where even the principal loan which was forgiven, the portion of that, IRB wanted to tax the taxpayer, and I had to go and argue and say, look at section 30, subsection 4, you must first enjoy deduction first. And principal that you pay for a loan, you don't even get a deduction. How can you even come and tax that? So then they eventually gave up, but they're very aggressive.
Okay, Steve, maybe the next question is regarding withdrawal of stock. What documents is required to justify the intention to hold, or so that you don't trigger 24(2)? Maybe Sarah will be probably, do you want to take that?
24(2), you see, as I said earlier, if you have a stock, assuming you got a showroom, a shop lot, or a office premise, you then decide to turn it into HQ or use it as your office. That is withdrawal of stock. Because that is stock meant to be sold or using it for yourself. Withdrawal of stock for own use. But if you have a situation where you got these shops, you can't sell them, you want to sell them. So what do? You find a different way to sell. Remember, in a difficult position like this, you have to think out of the box. So you think out of the box, you find tenants. You find tenants who go occupy these rows of shops. Then you sell tenanted buildings. And you say, listen, 6% return. There's a tenant paying for you. That cannot be withdrawal of stock. That is how you sell your stock. You see? And when I did the Mercedes-Benz case, I gave an example in court. If I got oversupply of stock, what do? I gave an example of a fisherman. I go to the sea to catch fish. I catch 10 bakul of fish. I only can sell 4 bakul, fresh fish. 6 other bakul, what I do? I go into salted fish. That is the way I sell my stock. Now from fresh live fish, it became salted fish. That cannot be withdrawal of stock. You see, that is how I sell my stock. So in this case, you must bear in mind, when developers do this, you must have a good reason how you're doing it. Example, you may end up selling buy one, free one. I don't know. Dato Soo is smiling, so you may end up thinking of idea. Buy one property, you may get one. Remember, I was told in China, if you buy property many few years ago, you can get one of their projects in Malaysia for free. I mean, this is all stolen, So there are many ways to sell products, That does not amount to withdrawal of stock. But what I will advise developers is to keep documentations properly, like your board papers, your management papers, record this. One weakness I see in development industry is documentation. Because when the time IRB come and knocks on your door, everybody asks each other, nobody knows how, difficult to prove. Because IRB wants evidence in writing, you see. So very important for developers to, at this juncture, to pay some attention to documenting why you're doing certain things like this.
I echo what Sarah said. So I think documentation is key. And the board papers and also the actions that you all take, for example, do you still basically get marketing agents to actually work on those units to actually get that to be sold? So those are good documentary evidence that you need to keep in place to support that there's always intention to actually sell.
Okay, maybe there are some questions on Facebook Live also. So I think we take some questions from there. I think one of the questions is that to confirm whether interest expense is deductible if there's a loan moratorium on the deferment of actual payment, even though the interest is due. So basically, I think, Steve, the question is that, can you take a tax deduction for the interest expense, given that it's a moratorium that you don't need to technically pay yet, you have to pay it later, but the interest is actually due for payment? I think that's the question that the person is trying to ask.
So it really goes back to the documentation in the with the banks. If you are saying that, because actually the way how I see is that with a loan moratorium, you're basically asking for the deferment
of the interest payment, yes. So it's not due.
And also the due date, because they are not allowed to sue you for that amount because they're giving you this moratorium. So the way how I'll see that is that that deferment itself is tantamount to a deferment on the due date already. And that's where you are
follow the due date.
The deductibility later. But you must also bear in mind the law is a bit sort of unique here, is that even though the due date, the deductibility is based on the due date, but the year in which you take the deduction still goes back to the year in which the interest is payable. That's how 33 sub 4 has been worded. So say, for example, if you have an interest that is you're supposed to pay in 2020, you get that deferred, say, by 9 months, and you pay that in mid-2021. And assuming you're a December year-end case, what it means that by the time you submit your tax return in 2021, so say you file your return in July 2021, and that payment that relates to 2020 is already due, say in May 2021, then you would be able to then take a deduction in your tax return for 2020. Okay, so those are the sort of the fine points that you need to look at. So just bear that in mind.
Okay, another question is, when you use your inventory to be pledged as collateral for a loan, will that be deemed as stock transferred as fixed asset and hence attract income tax on the gain based on current market value?
Interesting question. Actually, I don't have an answer, a clear answer for that, because are you using it for your own use? I mean, I don't know what's the accounting treatment. Steve could guide me on that. But from an income tax position, whether the 24(2) applies or not, it'd be interesting point to do research and to check on. I don't have a clear answer on that from a tax position.
If you ask me, my take to that is, if just purely by the fact that it is actually used as a collateral, as a security for your loan, I don't think so. I think we still have to look at it on the overall basis. How do you actually look at the stocks? Because for manufacturing companies, it's very common for them to basically use their stocks to actually get credit lines and all that. So I don't see any different with that of a developer.
Yep, I agree. Okay, because we are running a bit short of time, we are we'll end at 5:30, so we'll take a few more questions. We really thank all the participants for all the questions. Okay, the next question is, if a company pay GRR to a landlord and the company rent the unit out to a tenant, therefore will the company enjoy a deduction if it gives discount to the tenant? I'm assuming that the company here probably is referring to the person who's receiving the GRR, the landlord that's receiving the GRR.
Yeah, the answer is yes, as long as the landlord here meets the relevant conditions, so they should still be able to get. And one key thing I must remind you all, this only applies to business premises. Yeah. So if this is GRR on shop lots, then yes, you can qualify.
Okay, there's a question on rental agreement entered into with tenant under his personal name rather than the business name that is operating. However, for the purpose of renting, the shop lot is clearly stated in the agreement for business purposes. So is the landlord still eligible for the additional tax deduction if the tenant's business fulfills the SME condition?
I believe that really depends on the status of the tenant, because if this is actually, if the tenant operates as a sole proprietorship, and basically the tenant is basically then signing its own name to use for its sole proprietorship business, so in my mind, then that should be allowable. But of course, if you say that the business is actually carried out in a company, then I will find difficulty trying to support this, because one of the documents that's required for the deduction is also the rental agreement, as well as documentation to show that you have given the rental rebates to the SME business.
Okay, one quick question is, can IRB tax debt forgiveness under Section 4F?
My view, no, because there's a specific section 30 subsection 4 that makes it a business source income under Section 4A. That'd be my immediate view. Otherwise, everything goes under 4F, you see. 4F cannot be used so widely in the way IRB wants things. Because a specific section prevails over a general section.
Yeah, okay. I think that is the principle established in the Dosa Jaya case as well, right?
Yeah.
Okay, maybe we'll take one last question, and because I think we need to wrap up now, because the thing is that I think we have got some Muslim friends that are joining us, which will have to probably start getting ready for breaking fast. So we don't want to drag this session too long. Maybe we'll take the last question on the. Okay, I think this is an interesting thing. What if I temporarily occupy the shop lot while sourcing for a buyer? considered withdrawal of stock. So which means that this one is a developer, I presume, developer occupying the shop.
Steve, how long is this temporary?
Yeah. I
1
think
week okay lah, 1 month okay, but 1 year and a half.
it is all a question of facts, and I'll tell you, unfortunately, RRB always have the benefit of the hindsight. So you may go with the intention of of occupying that for 3 months, and you ask tax agency, yeah, that's fine. But in the eventuality, actually, you will be occupying for 2 years. I think that's where things get a bit more dicey.
Yeah. If you're going to stay there for short term, don't tell anybody, just quietly stay there. So no one knows. That's the only practical advice I can give.
Okay. Maybe Dato Soo, this part, I think I leave it to you. I think there are a lot of questions on this Bumi quota release fee and all, whether tax deductible or not. I think maybe you can just update a little bit. I know there's no answer yet, but maybe you can just.
Okay, on this Bumi quota release fee, including in some state there's a penalty involved. REHDA actually has, together with Sarah actually and Steve, we have actually attended to this issue. We have actually written to the Ministry of Finance, but unfortunately, there's a change of government in between also, a change of person in charge also, you know. So perhaps we have to kickstart the entire process again to approach this new administrator to perhaps to understand the issue. But just want to share that during our last discussion with the Ministry of Finance, they sort of like agree with the principle of the case. They understand, like what Sarah say, the deductibility of the items, a legitimate of the expenses, you know. So of course, REHDA will continue pursue this matter until we got some outcome. Perhaps then we will actually inform all the members.
Okay, I think we probably have to say goodbye to everyone now, because I think it has extended beyond the original plan time. Thank you everyone for your attendance.
Thank you again.
Okay, thank you to all the panel speakers, Dato Soo, Steve, and Sarah.
Thank you very much.
Okay, to all Muslim friends, selamat berbuka puasa.
Yeah.
Okay, I think we can't stay home now, okay, except for baby Steve is staying home. But everybody stay safe. Thank you very much.
Yes, thank you.
Okay.
Bye-bye.
Thank you. Bye.
Bye.